Guys, your Uncle Paul here. I'm always looking for investment ideas that might be very interesting, and I think our community members have found something of immense interest. Whether you're new to investing or an experienced investor, I guarantee that in this video, there's something here for everyone that'll help you walk away understanding this company and its fundamentals a lot better than you did before. You'll be able to use this analysis to apply to any company out there and figure out if it hits your price that you want to have in order to make the purchase or not. Let's go check out Eagle Materials, ticker symbol EXP. Now, this one was originally found by our in-house analyst, Dalton, but it has now gotten a little bit of attention. It is a $6.2 billion company with an all-time high just last month of 195.96. Oh, that's my Twitter. Okay. So this is a company with a current PE of 14. It's in the construction business. They make a lot of construction materials. Mo, you shaking your head here. Why are you shaking your head?
I mean, it's in the construction business, like you
Which
said.
has been booming.
It has been, and the question is, will that continue if there's any type of recession, whatever?
So I'm going to explain my bias here.
Okay.
When I find a company that I feel is sitting at a good valuation because of a recent boom. Now, remember, construction has gotten even better than even it was 5 years ago.
Definitely.
The question is, how long can that last?
Right.
It could go on. Remember, before 2005, 2006, you just knew that you bought a house and it was going to go up in value 2 to 4% a year, like clockwork, 5%. It was just going to go up. And then we hit 2005, 2006. The great financial crisis happened. Home prices plummeted. And now people are like, oh, I'm waiting for another housing crash. And I'm like, okay, well, I said early on that inflation was high, home prices could still stay high. And for a while they dipped and they came right back up. I'm not saying I was right or wrong. I just sat there and realized that home prices rely a lot on inflation. So yeah, interest rates were high, but inflation's been high as well. So if you increase the cost of materials, what's going to happen to home prices?
Go up.
Yeah. So let's look at this income statement here on this company.
Okay.
Look at the jump here in Mo and revenue. So
Wow.
1.1, 1.2, 1.4, 1.4, 1.4, 1.6, 1.8, 2.1.
Yeah, that's big jumps.
Big jumps in revenue. Yeah. Now, that doesn't mean you should dismiss the company. No, but just remember this as you go forward. You want to look at companies and figure out their full cycle profit. What are they going to make in a full economic cycle? That means boom and bust. Okay, so let's go back to when they busted, when the economy busted. Now, the one caveat I'll give to 2000, oh, look at this. Now, this is a major great financial crisis. 585, 800, 950, 800, 640, 475, 464, 474. Guys, it took them. 2006, they did almost $1 billion in revenue. The next time they hit almost $1 billion in revenue,
14,
was 2014 when they hit $1 billion. That was 8 years. So if I told you during this great economic boom of housing that it would have taken 8 years to equalize this revenue, what would you have said? Well, Paul, you're crazy. Let's see how they did profit-wise. I will give them credit. Look at this, Mo. Profit, 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 profit. Oh, look at that profit, but still profitable.
Still profitable.
During that whole entire economic downturn. I like that about the company. Let's go see how they did in the following years. So they've only had 1 year of no profit. Let me guess, that was COVID. No, it was not COVID.
19, right.
It's actually 2019. Well, you know why? They had $160 million income from discontinued operations. So guys, whenever I see an abnormal year, what am I going to do? Okay, let me see why. I scroll up just a little bit, the line above. Income from discontinued operations. All right, so let's check out some information. Mo, give us some news on Eagle Materials.
So the big news out there is really people are figuring out what's going to happen with construction in the next couple of years. That's truly what it is, what it comes down to.
I don't get why they
construction material market size and how it's going to be impacted and what's going to be the compounded annual growth rate for the next several years. Again, economists prepare for a rocky road, first half of 2023, yada, yada. And that's really what all the news is. I did a quick Google and it was just what's going to happen to construction.
And you know what Warren Buffett and Charlie Munger say? When you have an economist on staff, you have one too many people on staff.
And to me, I look at this and say, I don't really care what happens to construction. Is it going to dip? If it dips, great. If this is a good company, I'm going to buy more of it. If that's the perception.
Yeah, that's the thing. You have to sit there and understand that. So for a company like this, I want to understand what is their plan going forward? Like, how is their business structured? Because we saw that even during bad times, they still made money.
I like going back to 2008, 2009 and seeing, we were profitable. Barely profitable, we were still there.
Here's what's interesting. Their gross margin's 30%. That means for every extra dollar they sell, 30 cents goes to the pre-tax profit. And look at their 5-year profit margin, 16%. That's after taxes. And 1 year is 21.8%. So now this is a big difference. These two numbers are big. I want to understand which one's more likely to occur now? Is there a reason why 21% might occur? Now, look at the 5-year average free cash flow, $400 million. Their 5-year average net income is $275. So higher free cash flow than net income. I like that a lot. And they're selling for 14 times last year's free cash flow. They actually pay a dividend. Interesting.
Small, yeah.
0.6% eats up $37 million of their free cash flow, but they can easily afford that.
Oh, very easy.
Good return on invested capital, 11.44%. So my question is, what kind of business are they in? Are they just supplying materials as they're requested? Like, we got to understand that as part of the business. That's one of the things I would want to understand as an investor. How are they able to generate so much bottom line profit on this kind of gross profit margin? That's interesting to me. Okay, what else we got here? Let's go check out the 8 pillars, which is right above. Well, look at this.
So they have a share repurchase program in place too.
Well, yeah, look at this thing.
And they are buying back shares. Yep.
So for those of you guys who don't know what share buybacks are, first off, they should only be buying back their shares if they are cheap. But second, here's how share purchases work. If a company has 10 shares outstanding and you own one, you own 10% of the business, 1 out of 10 shares. They buy back 2 shares. They now only have 8 shares outstanding and you still own 1. That's 1 out of 8 shares. That is 12.5% ownership now versus 10 before. So as long as the company is buying back good shares, because you might sit there and say, well, Paul, if they buy back expensive shares, I still get a bigger piece. True. But them buying back their own shares at an expensive value is the same like them buying another company at expensive value. That's not a good use of your capital. They're not going to get you a good return on that money. You want to get a good return on the money that you have access to. What you have, that you are essentially an owner of, which is what happens when you own a company. You own a piece of that cash flow. You own a piece of that bank account. So they're buying back 26% of their shares in the last 5 years. Mo, what's their plan?
Here's their plan. So share repurchases made from time to time. Timing, let's see. So through June 30th, 2023, we've repurchased approximately 49 million shares.
Wow.
The board has approved a repurchase of 56 million shares since we became publicly held in 1994. Okay, so they
still have
they still
7
have
million.
a lot to go.
Yeah. Okay. Share repurchases may be made
here
from time to time in the open market, or timing and amount of any share repurchase are determined by management based on its evaluation of market and economic conditions and other factors. Okay, so.
And it's interesting. I came to their income statement here to see when they were making their repurchases.
They've been doing it consistently along the way.
Yeah.
Oh, no, you're right.
A couple years where they weren't.
Oh, yeah, you're right. And then they really started to get aggressive.
Like here was interesting. They actually diluted you a little bit because maybe their price was so high. I don't know. And then they started buying back. I don't know the price fluctuation, how it's been, but it's interesting.
$1 per share in dividends.
Mm-hmm.
Okay, so guys, this is an 8-pillar company. Doesn't mean you go out and buy because it's 8 pillars. It's about telling a story. Here's what I do like. Everything is growing. Debt seems reasonable. And the other thing is their PE is higher than their price to free cash flow. This means that free cash flow is higher, right? So if those who don't understand the math of it, when the denominator is high, the ratio is low. So I'm glad that their free cash flow is higher than their earnings that I showed you earlier. All right, so what are some bull and bear cases for this company, Mo? What's our community saying? So guys, in our community here, we always put it out there to people to sit there and talk about their bull and bear cases of companies.
So here's Dalton, a big tailwind from infrastructure and the Job Act fund from the government, of course, awarding contractors in areas of Eagle services. Competitive advantage due to the 25 to 50-year worth of material reserves, as well as a 60-year deal with Santee Cooper, expiring in 2068, providing with gypsum. It's a fertilizer, or it's a component of fertilizer, where there can be a shortage.
Well, this next one, 70% of its business is located in places where population growth will be 3% higher than the national average. Wow. Okay.
CEO and other executives are no thrill by their nature and are incentivized heavily through the performance bonuses. 60% from long-term performance bonuses.
That's good.
That is good.
That's really good.
Let's see down here. Bear cases around 60.
By the way, let's explain that real quick.
Yeah, go ahead.
If the management team has incentives that are aligned with investors, you know they're going to make decisions that are best for the company. If they're just incentivized in some random way, then they're going to do whatever it takes to show, like Palantir did.
Yeah.
They had to hit a couple of EPS beats, and they all of a sudden got big bonuses. Here, it's based on return on equity targets of 40%, as well as other metrics from performing operating income, EBIT, EBITDA, et cetera. As they grow those things, you as an investor will do better as well.
Yeah, there was a company I was looking at the other day. I can't remember what it was, but the CEO and CFO owned a combined 3% of the company. Okay. And I was like, it was a rather small company. Maybe
for a small company,
it was like $4 to $6 billion range, and I was like, oh, I don't know how we feel about that one.
I mean, that's still a big chunk, Mo. 3% of $4 billion is still $120 million. What also matters to me is the majority of the CEO's net worth tied up in the company. Yeah. So yeah, look at a company like Microsoft. They have $2 trillion. Even if you pay, I think their CEO had just crossed the $1 billion mark.
Even if you put everything in it, it's a drop in the bucket.
Yeah, but for him, that's a big piece of money.
Of course.
So you sit there and say, okay, it's about balancing those two things out. Is the CEO, is the vast majority of their net worth, so if the CEO, for example, was with $100 billion and $100 million was invested in the company they ran, I'd be like, well, they don't care. Nothing's going to matter to them. They're going to be like, oh, it's nothing part of my net worth. Mm-hmm. So that's what matters a lot, looking at this balance of things. What else you got, Mo?
So a couple of bear cases. Around 60% of cash flow from operated is dedicated to capex, as the business relies on a lot of capital being reinvested each year.
Oh, wow. So it is a very high capex business.
Seems that way.
Okay, let me look at that real quick. So I'm going to go to the cash flow statement here. And capex, okay. So last year was $130 million. Their revenue was $2.2 billion. So that's roughly 6%. Okay, it's 6% a lot. That's a good question. I don't know. Go ahead, Mo.
Management only holds 2% of the float outstanding.
Poop.
Yeah.
That's not good. All right. Let's check out the analyst estimates here real quick.
Yeah, construction market is cyclical, yada, yada, you know.
So, but for the next year, guys, $14 all the way to 18. That's some big growth here. Now, again, it's not a big company. It's $6 billion, so not a lot of analysts. And remember, analysts have their biases. So you have to make sure that you understand where they're coming from. Revenue, all right. Decent growth.
Yeah.
Mid to high single digits.
Yeah, exactly.
Nothing to write home about.
No.
But I like that. I like simple businesses.
Fine. You don't need to have 15, 20% growth.
This to me is a simple business. How's it done year to date? It's up 26% year to date. Wow, look at that. And by the way, that doesn't matter to anything. I'm just surprised. Up 53% in the last 1 year. Holy cow. Wowza. So look at this, guys. This is why you shouldn't follow just, how's the stock done? Last 10 years, it's up 152%. The last 5 years, 110. So 70%, 70% of the last 10-year growth came in the last 5 years. Look at it this way. A third of the growth in the last 10 years came in the last 1 year. Mm-hmm. So don't just chase these things. Understand you're buying a business. And as long as the fundamentals keep getting better, if you pay a reasonable price, in all likelihood, your stock will also perform the same way. It's hard for a company to outperform the absolute fundamental business growth completely.
Over a long period.
Over any long period of time. If a company's profit grows at 10% a year, it's hard to exceed that unless you get a massive discount in the company. That's the only way. And even then, once you get the fair value, it's only going to grow at 10% a year. So that's something really important. So, guys, next question is, what's the right price to pay for Eagle Materials? Now, guys, I talk a lot about the software. I talk a lot about the community. The community is so important, and I want you to join it. But I'm not asking you to make a yes or no decision this very second. What I'm asking you to do is to make an informed decision, and you cannot possibly make an informed decision from the outside. I need you on the inside. I need you in here, talking to the community, engaging with the thousands of people here, using our software and all of the tools that are all available to you. Just like you'd buy a car, you want to go take it for a test drive, but the difference is we're allowing you to take this test drive home for the next 7 full days, full access. Do whatever you want. Go in there, talk, say hi, engage, use the tools, etc. I'm so confident that during that 1 week period, you will have that moment where you go, I need the software, and you're going to sign up immediately. And if you don't, understood, no harm, no foul. Keep watching our videos because I think at some point in the future, you will see the value and you'll sign up. So let's go check out. Also, go to everythingmoney.com, sign up for that. Completely free. All you need is your email. Go sign up now. So, Mo, have you ever done EXP?
I have not.
I had done it. I did do it February of 2023.
Wow.
This is probably the first time Dalton mentioned it to me.
That's it. Oh, okay. Okay.
Because I had never really talked about it. I think he might have mentioned it.
Okay.
Now, I'm doing a 10-year analysis here, guys, and this is our stock analyzer tool. So I'm going to make assumptions about the future and not including the balance sheet. I'm going to say, by the way, just because people in our community own it doesn't mean you should own it. Come in here, have that conversation there to understand better why people have bought it because everybody's goals are different. So Mo, for revenue growth, I did 0, 3, and 6% over the next 10 years.
I did 1, 4, and 7.
Okay. Like I'm just sitting there saying, let's say they just end up going along.
Yeah, exactly. Or let's say that we go into a recession. It's hard on building materials for 5 or 6 years.
Yeah. And then they finally get back to growth.
Exactly.
All right, profit margin. So I did 12, 15, and 18. And here's why I went lower. They did 16%, but they had this 1 year right here of 21%. So I'm going to just go and say, hey, it went really high here. Maybe it falls back a little bit. So I went back to 12, 15, and 18%. Mo, what'd you do?
I'm going to go 13, 16, and 19.
Okay, good. Free cash flow. Apart from this last year, the last 10 years and the last 5 years, free cash flow was significantly higher than the profit margin. So I'm going to assume the same occurs here. I'm going to put 16, 19, and 22%. So that's 4% higher in every low, middle, and high than the profit margin. Mo, what are you doing?
18, 21, and 24.
Oh, wow. Okay.
Yeah.
Great. So Mo's gotten higher than me on every single level so far. So Mo's numbers are probably going to end up being higher depending on when he puts up PE and price of free cash flow. The current PE is 12.5. The current price of free cash flow is 14. I put, for 10 years from now, the end of our analysis, I put 12, 14, and 16 times earnings. I don't know if that's the right number. By the way, Mo, did you see their ROIC is growing every year?
Growing.
So these guys are good at capital allocation, it appears. So maybe I'm being too low here. I think part of my bias was, did I really want this company? What's your PE?
I went 14, 16, and 18 because of that ROIC.
Okay. So because of that, Mo.
And if they can do those high numbers that I assumed, I'll give them the premium.
And I don't blame. So guys, what he's saying is, listen, high return on invested capital means they manage their money very well. They get a good return on the money that's in the business. So as they generate more and more cash flow, they're going to get a better return for investors with that. That deserves a premium. You should pay a higher price for high return on invested capital businesses. Now, the last line is desired annual return. This is where I might deviate. I put 12%, 14, and 16%. This is my margin of safety. I might actually go lower. I might go 11, 13, and 15 because I already beat up the PE.
That's what I did, and that's why I did it.
Okay. So guys, I'm going to hit the analyze button. Mo, hit the analyze button. I just need you for 1 or 2 minutes longer. Stick with us. We want to explain these numbers so you understand what we're doing here. We're trying to teach you how to fish and teach you that process. So the stock is currently at 170. Low price, 70 to 100. High price, 145 to 180. Middle price of 105 to 130. If I pay today's price and my low assumptions occur, I'm going to make 2.6%. If my middle assumptions occur, 9.3. My high assumptions occur, 15.8. So I'm probably not a buyer at this price, but I'm definitely going to keep track of it. Mo, what'd you get?
So I have 90 to 125 on the low end, 177 to 223 on the high end, 128 to 168 in the middle.
All right, so you've got...
I'll probably put on my watch list maybe 175.
Okay. I'm going to put up my watch list.
175.
Yeah.
You know what? I'm going to go...
I'm going to go 150.
Yeah, that sounds good.
Because even though it's higher, 150 is higher, I want to be able to reevaluate the company and do a little more digging if it falls further. Guys, everythingmoney.com. Sign up for our free 7-day trial right now.